somewhere in a vault right now. A number is being multiplied by a machine that doesn't exist. No gears, no furnace, no printing press, just a keystroke. And suddenly, there is more money in the world than there was a second ago. This isn't theft. It isn't fraud, at least not on paper. It's the operating system of modern finance, and almost nobody who uses it understands how it actually runs. To find where this began, forget the goldsmiths you've heard about. Go instead to the port cities of the Crusader era, where a militarized order of monks, the Knights Templar, built something closer to the First International Bank than anyone realizes. A pilgrim traveling from Paris to Jerusalem in the 1150s carried enormous risk. If he carried gold, bandits, shipwrecks, war. So the Templars offered an alternative. Deposit your coin at a Templar house in Europe, receive a coded letter of credit, and collect equivalent funds at a Templar house in the Holy Land. The Templars weren't just guarding wealth. They were creating a network where a promise could travel faster and safer than metal ever could. And because deposits sat in dozens of houses across 2 continents, only a fraction were ever claimed in any city on any given day. The rest financed something else entirely: crusades, castles, and loans to kings, including, eventually, the King of France, whose debts to the order may have contributed to their downfall in 1307. Even then, the pattern was visible. Whoever controls the promise of money can create far more of it than physically exists. The idea resurfaced with new precision in Amsterdam. In 1609, the city founded the Wissel Bank, built partly to fix a chaotic mess of coins clipped and debased by merchants across Europe. Depositors handed over unreliable currency and received a clean, standardized account balance, instead a form of money that existed only in a ledger, never in a pocket. For decades, the Wissel Bank prided itself on never lending beyond its reserves. But even here, temptation eventually won. By the 1780s, historians have found the bank was secretly extending large loans to the Dutch East India Company, quietly abandoning its own founding principle. When the truth surfaced, confidence collapsed, and one of Europe's most trusted financial institutions dissolved within a generation. The lesson repeats across centuries. Full reserve promises are fragile promises, because someone in charge almost always decides that idle deposits are wasted opportunity. Then came a warning written in catastrophe. In 1716, a Scottish financier named John Law convinced the French crown to let him build a national bank, Bank Royale, that issued paper, notes, and expanded credit to fund colonial land speculation. In Louisiana, through the Mississippi Company, shares soared. Ordinary Parisians became instant millionaires on paper. Law had essentially industrialized the old trick, issuing far more paper promises than metal reserves could ever cover at the scale of an entire nation. By Etienne Suberarshir, the bubble burst so violently that millionaire entered the French language as both a compliment and a warning. France's monetary system was so damaged that the country avoided paper currency again for nearly a century. Fast forward to a system without kings or goldsmiths, but running on the exact same logic. Here's how it works today. Strictive jargon. A bank doesn't wait for your deposit before it can lend. When it approves a loan, it simply creates a new deposit in the borrower's account. New money, typed into existence, backed by nothing but a signature promising repayment. Economists call this endogenous money creation. And central banks themselves, including the Bank of England and a widely cited 2014 explainer, confirmed that this not the old textbook model of lending out. Deposits is how most money actually enters the economy. In the United States, roughly 90% of the money supply exists this way, as digital bank credits, not physical currency issued by the Federal Reserve. So what stops a bank from lending without limits? Not reserves. The Federal Reserve dropped reserve requirements to 0 in March 2020 and never restored them. The real leash is capital adequacy, rules from the Basel framework, negotiated by central bankers in Switzerland that force banks to hold a cushion of their own, shareholder equity against risky loans. It's a brake pedal, not a fuel gauge. And when that brake fails, the results are historic. Consider Silicon Valley Bank in March 2023. Not a collapse from reckless lending, but from a bank so flush with deposits that it parked billions in long-term government bonds, only to be caught when rising interest rates crushed their value. Depositors, moving faster than any 1929 crowd ever could, withdrew over $40 billion in a single day through mobile apps. The bank that regulators called well-capitalized was insolvent by nightfall. Confidence, not gold, was always the real reserve. This structure produces three quiet, permanent forces. Money supply expansion, because new loans mean new deposits. Prices drift upward over time, even without anyone printing a single banknote. Structural debt, because every dollar of bank money is born as somebody's liability. The total debt in the system mathematically exceeds the money available to repay it forever. And a widening gap, because those who hold assets, like property and equities, benefit when asset prices rise with the expanding money supply, while wages, stickier and slower, lag behind. None of this makes the system evil. It makes it fragile in a specific, knowable way. A structure built entirely on trust, refreshed daily by millions of people who never ask where their money actually comes from. The Templars proved a promise could move faster than gold. Amsterdam proved even careful custodians eventually spend what isn't theirs. Paris in E10C by Archer proved that paper multiplied too far always meets reality eventually. And Silicon Valley in 2023 proved that in the digital age, confidence can now evaporate at the speed of a push notification. Perhaps that's the real inheritance money leaves us. Not wealth, but a shared act of belief, renewed every single day in a number that was never fully backed by anything at all. The ledger doesn't lie because it's broken. It lies because we agreed centuries ago to let it.